I'm Gustavo Cariconde, and you are on startupspace.io. And today I have here with me Patrick Rogers. He's one of the co-founders of Clara, and they are launching a startup to solve a huge legal issue. It's very interesting for startup founders to learn what they're doing, because it could help actually a lot with your own journey if you are working on a startup. Hello Patrick, how are you?
Hi Gustavo, I'm well, thanks. How are you?
So can you tell us a little bit more about Clara?
Sure thing. So our team at Clara is comprised of a group of highly experienced startup lawyers who have assisted founders across the world with all of their needs, with a particular focus on venture capital. We've advised hundreds of founders, helped them raise in excess of $200 million in the last 2 years, I think. And we've learned a lot of lessons in that time, seen founders make the same types of mistakes, and realized that the type of advice and education that we give to founders is pretty much the same across the board.
Right.
Your average founder is a first-time founder.
Okay.
So they don't know what they don't know, and they typically view legal issues as an admin item.
Right.
So they don't put any focus on it. And then they're forced to focus on it at the worst possible moment, which is typically when they're out of money and they're trying to raise money, and they have to do kind of a crash course on all things legal. And this leads to terrible consumer experiences.
Okay.
And there's too much money spent on lawyers and too much lawyer time needed for a lot of stuff that, in our view, is commoditizable. If you can design a process around it, build software around those processes, you can create a far better consumer experience for all the parties in the ecosystem, whether it's founders, their startups, investors, accelerators, incubators, what have you. All of these guys have to deal with legal. It's not fun, it's not sexy, it's not exciting.
Right.
And everyone is, but all these guys are scared of the idea of lawyers, right? They hear lawyer jokes, everyone thinks they're super expensive, which they are. So we're trying to completely refashion how all of this is done.
Cool.
Using the best of both machine efficiency as well as human expertise.
Okay, and what are the top mistakes that early stage founders and entrepreneurs they do when working on their ideas, startups?
I mean, broadly speaking, the number one mistake is that they don't go to lawyers or think about legal stuff early enough. So even something as simple as educating themselves on what a good legal structure looks like, what an investable legal structure looks like from a VC's perspective. And historically, lawyers have had to deliver that education, which is one of the reasons why a key foundational component of Clara is our education function.
Right.
So we are filming hundreds and hundreds of short 90-second videos on discrete legal topics that can be delivered on demand to startups when we know they need to learn about it.
It's already available.
We are creating these right now.
Okay.
So the YouTube channel Clara Academy is created.
Okay.
You can start looking at that pre-launch. But this is one of our big services to the global startup community. Going back to the point about the mistakes, though, all of these mistakes stem from a lack of education.
Yeah.
And that is the foundation of any proper startup. Founders need
knowledge about legal issues
to avoid pitfalls.
Right.
Like, a couple of easy examples are when you incorporate your first company, you can't just simply incorporate it in the country in which you're operating.
Right.
The rules and regulations of that country might not be palatable for venture capital investors. They may not like it. Right?
Okay.
I include all of the GCC. I include Brazil.
Okay.
Right. Civil law.
Yeah, those countries are not suitable for VCs.
No,
Can you
they
explain why?
don't like them because the laws are outdated in many senses. The court systems do not work efficiently. It might take 3 or 4 years to hear your case.
Right.
The judges won't have an understanding of how venture capital works. The laws of, say, the UAE, don't allow for multiple classes of shares, right? So investors always want preferred shares to help protect their investment.
Okay.
You just can't get them under the laws of the UAE. So by and large, sophisticated investors prefer to invest into common law jurisdictions where there are robust intellectual property laws in place, where you can get things like preferred shares, where a company can create something like a share incentive plan to attract talent, and where if an investor needs to enforce their rights, there's a court system and apparatus that is well-versed in all of these terms and can make this process very efficient.
Okay, and that will be like a investor's paradise, right?
But it exists all over the world, right? And that's why so we are building Clara for an initial set of jurisdictions. They all happen to be common law. So Delaware, the UK, Singapore, Abu Dhabi Global Market, ADGM, Cayman Islands, BVI, and Canada. So that's kind of our initial set and target list. All happen to be common law jurisdictions. Their laws are based on historical English law, case law, and venture capital very much desires to invest through those jurisdictions. Now, just because you set up a company in one of those jurisdictions does not mean that your team of employees is living in that jurisdiction.
Okay.
So
you can have a company there, but operate from another.
You have multiple companies, and this is something that is very common in emerging markets. You'll have a lot of emerging market founders watching this video, some of whom will be from the Middle East or Africa, will have some familiarity with a company called Careem, which Uber recently purchased for $3.1 billion. So Uber did not buy a Middle East company. Uber bought an offshore company in one of those jurisdictions that I just mentioned. But that offshore company owns all of its other operating companies in all of the countries it operates in. But Careem's intellectual property was held in that offshore company. The share incentive plan was structured at that level. All of the investors invested money at that offshore level. That's where they get their investor protections. The shareholders agreement they sign is fully enforceable. So significant de-risking from an investor perspective. So I'd say that's mistake number one. Founders just assume that wherever they set up, they can raise money by selling shares in that company. It's not the case.
And they won't be able to attract investors. They won't. They're really serious.
Exactly. So we see founders waste a lot of money and time having to restructure their startup from a legal perspective before they're able to raise money. Whereas if they just did a little bit of education at the outset, they would have saved a lot of time and costs in doing that. Other mistakes we see is selling down too much equity at an early stage. A lot of founders will get quite excited when they get a first email from an angel investor says, "I love this company. I want to give you $200,000, $250,000." Oh my God, someone believes in my idea. This is fantastic. And then they end up selling them 50% of the company. On day one. And that's an absolute red flag for future investors.
So you also provide some guidance about
best practice. As an example, you should in any round you should never be selling down more than say 20 or 25% of your capital. If you do 50% to one individual, even if you have a great business, you're going to be scaring off investors in the future. And that's a mistake that you can't really recover from. I can't tell you how many very promising startups we've advised over the years where they come to us, they're generating revenue, the business model is sound, but because they did not get familiarized with the legal concepts early on, they've kind of ruined their company and they can't raise money. So they have to wind it up. And it's a shame. And that's a big impetus for us in building Clara, to get to the founders earlier, help them with this education piece, put them on kind of a guided journey without necessarily the need of human lawyers who are very costly. But at any point when they need to be working on more complex stuff, we are building a curated marketplace of startup-friendly service providers that we can push them through to, who work on a fixed fee basis, are far lower cost, but are also at the top of their game and know exactly what they're doing, and have built their service model around servicing startups.
Tell me how guys also can help investors.
Investors have they have a number of problems with startups. One of them, as an example, is reporting. So if you're a venture capital firm and you give $1 million to a promising startup, you are expecting certain information rights. Okay, so you might have access to the monthly management accounts. You might have to be notified when the startup takes certain actions, like entering into a big contract or entering into a joint venture, whatever it is. But founders, by and large, are very bad at reporting.
Right.
Even something like updating the cap table when they are issuing new options to employees.
So you keep track of
Founders forget how to do that stuff, or they mess up the Excel sheet. So, we're creating and building cap table software within the Clara platform to allow founders to issue those equity instruments through the platform and through our integration with DocuSign. When the agreement gets sent out and comes back in fully executed, the cap table automatically updates.
Right.
So we're taking the user error out of it. Right? So I'd say near the top of the list of complaints of investors is access to information and accuracy of information, because again, your average founder is a first-time founder. They haven't been through this process before. They're really trying to focus on building their products, building up their teams, getting to market. They don't have enough cash to hire an in-house lawyer, right? And they end up trying to do it themselves. And by and large, they do it quite poorly.
So you also have a system to do some sort of due diligence on startups and present to the investor reports.
Yes, exactly. Precisely. So another element of Clara is what we call the health check. Because we have structured all of a startup's legal data, so we digitize all of it, right? And using our kind of best practices algorithm, we can instantly show a founder where the gaps are in their, let's call it, legal hygiene. Okay? So we can say, these are the kind of the red flag issues that an investor might call up.
Red flags you see from startups.
Your holding company is in the wrong jurisdiction. So if you try to raise money tomorrow, based on where you are now, you're 4 months minimum from doing so, because you're going to have to restructure this whole thing. Not transferring IP from third-party developers. Right? So a lot of people use outsourced developers in South America or in Eastern Europe. So these are not employees, okay? But they don't sign any form of agreement with these companies. And so then there's a big question mark as to who owns the intellectual property that's been created. Do the developers own it, or does your company? Your company needs to own that. But if you have no agreement that's transferred those rights, investors like that.
Because they don't even know, right?
A lot of founders don't, right? This is an education thing. We are only dealing with venture-backed or venture-backable tech companies. These are not brick-and-mortar stores where they are manufacturing goods, right? The entire value of the business is contained in the intellectual property that's being created. So if the people that are creating that IP for you haven't transferred all of their rights to the IP to your holding company, that's a big problem. Right? Another one would be something like vesting of founder shares. Right? So your average company has more than one founder, and particularly in jurisdictions like the UAE, where people are moving from all over the world to come here and collaborate, it's a far higher risk environment for things going wrong amongst co-founders. Right? Someone says, someone's gotten sick at home, I need to leave, or this just isn't working out for me, my partner doesn't like it here, we're moving home, or I need to take a job. If you as founders haven't agreed to vest your shares over time, saying, look, we're going to get these shares today, but if we leave before 4 years or 5 years, then some of those shares can be taken back from me. Right? Because I'm out, I'm not contributing anymore. Right? And when vesting or a clawback isn't dealt with early on by the founders, again, it can lead to some bad results. Every VC in an early stage goes in and invests in an early stage company will insist that vesting of founder shares occurs. So, but it safeguards the company if founders do that themselves early on. And so we kind of teach founders about that concept, teach them why it's important, that it's de-risking them vis-a-vis each other. Because if a founder leaves with 30% of the shares and is no longer contributing to the company, and then you try to go and raise money on that company, you're going to have an incredibly difficult time. Because the first thing the VC is going to say is 30% of the equity has disappeared. it's not bringing any value to the business, you're uninvested. You've only got kind of 70% of the bucket left.
Right. Now, Patrick, it sounds like a very sophisticated legal service that you provide. It must be really expensive for the startups to acquire this service from you.
That's a softball question for someone.
To solve this problem, right?
Yeah.
So tell us how you're going to provide all this value with an affordable, reasonable cost for the guys that are really struggling and they want to increase the size of their business, increase valuation, and everything.
Yes.
But they don't have many resources, right?
Yes. Yeah. So again, we're not trying to attract every startup in the world. We're trying to attract those startups that are investment grade. So you've either raised venture capital or you are on the cusp of raising venture capital. And that could be, we think we're going to get a term sheet from XVC, or we've just been accepted into Techstars or 500 startups or Startup Bootcamp. So that's signaling there that you could be investment grade.
Right.
And we're going to be working with those organizations to partner with Clara to make the onboarding and education of these startups a lot smoother and a lot less costly. Our model at Clara is primarily a SaaS model. So as a subscription service, and I'm not going to reveal pricing on this because it's still being finalized, but immensely affordable. So for the value that the platform might deliver to a founder in the first year across everything from building their cap table to automatically generating documentation that they can send out for signature via DocuSign, to providing this health check, to all the education that will be delivered, this is $15,000 to $20,000 worth of value that's going to be delivered for a fraction of that, as compared with what these people would have to pay a sophisticated startup lawyer to do for them. But again, the foundation principle, like I said, is we're trying to get software to do as much of this as possible, while being very firm believers that technology is not enough.
Okay.
There are a number of more complex, high value add items that founders need to take advice from professional advisors on. And that's not just lawyers. That could be, this VC is asking for evaluation, right? Or I need tax advice, or I need accounting done, or we've got to set up a new office in the US and we're trying to get our Indian developers in there. We need immigration advice. All of the professional services that we know that startups need, we're also providing a service around that because they don't know where to look for a lot of these guys. So with all of our experience doing deals and working with startups all over the world, we're putting together this curated marketplace, the Clara Network, it's called, so that once the Clara platform kind of caps out on its ability to assist a startup on a given matter, we can seamlessly push them through to a human advisor in the relevant jurisdiction with the relevant expertise that we know they need. We've already kind of pre-negotiated fees on behalf of the startups with these providers, so we can give an indication as to what those fees will look like. We can cite the lengthy experience of the relevant advisor, so that when the startup shows up on the doorstep of the advisor, they're well educated, their corporate structure is sound, they've already got a sense of what the fees are going to look like, and the engagement can proceed very smoothly. Right? And then once that advisor is finished with the engagement, if there's been any new documentation created, they feed that back into the platform, they structure the data. It could be a new trademark in Southeast Asia. Right? Okay, so XIP agent has just created the following trademarks for Y startup. That was a 4-month process. Once it's done, the agent logs back into Clara under that startup's account, uploads the new trademark registration documentation, and it becomes part of the startup's data room on Clara. So that's as an example of how.
Nice, very nice. Okay, thanks a lot, Patrick. I hope you have enjoyed my interview with Patrick, and tell where people can find you.
Absolutely, yes. So please visit clara.co. We'd love you to sign up and join the waitlist prior to our public launch in and around mid-October. Thank you.
And the YouTube channel is Academy?
The Clara Academy.
Clara Academy?
Yes. If you follow us on LinkedIn, Clara Technologies, you'll be privy to all the news as it comes up.
Thank you, Patrick.
Thanks.
Thank you.